Okay. So first, let me resolve confusion that I've created with dates and days. When is your mystery project due? I think one of the emails I said Wednesday the 24th, and there is no Wednesday. It's either the Wednesday the 22nd or Friday the 24th. So it is due Friday at 5 p.m. So just so I want to make sure. As you work through the mystery project, though, the only piece of advice I'll give you is don't fight the data. Okay? What I mean by that is you and I know what you'd like to see. You'd like to see a regression that works like amazingly, R squared of 90%. Everything is predicted. Okay? But you've got to take the data the way it is. And that's something in pricing you have to take as part of the game. You don't control the data. It's what is it is. Do the best you can. And remember, do you have to do a regression to find 5 cheap companies? If it works, it works. If it doesn't, it doesn't. It's a tool. And that's what I want you to remember. This is not about, it's not a statistical exercise where you try to fit the best regression you can and you have to use it. If at the end of the entire statistical process you decide that none of these regressions work for you in terms of finding the cheapest and most expensive companies, I'm okay with that too. Just take me through your reasoning as to why you're not controlling for things using statistics and say it doesn't work, therefore I'm using this instead. It's okay. So let's today we're going to talk about, we're going to complete the process of valuing private companies. And as part of the process, we're also going to talk about valuing initial public offerings or IPOs. For the most part, what you're going to discover is that the rules of valuation are exactly the same whether you're valuing an IPO or a regular company. There are a couple of twists about IPOs that can be tricky. Okay? So let's play a game. Most IPOs, you hire an investment banker to manage the initial public offering. The reason I say most is there is one very big exception to that general rule, right? You remember who never used an investment banker to do their IPO? Google, basically an auction. And to be quite honest, I don't understand why more high-profile companies don't do this. I can see why. If you're a small company nobody knows about you have to use investment banker. I'm surprised actually more companies don't adopt the Google pathway. But let's say you are the investment banker and I'm the company going public. You can make it Etsy, right? Last week's big IPO. Right? You first try an intrinsic valuation on my company. You come up with a value of $10 per share. But it's a social media company, and given how other social media companies are being priced out there, and I'll let you decide what the pricing metric is, you decide that investors will pay $25 per share for the company as a pricing. So my first question to you is really about mission. As an investment banker, if I come to you and ask you to do manage my initial public offering, is your job to value the company and take me public at that value, or is it to price the company and try to take me public at a price? What's your job? And give me the analogy that best reflects that. I want to sell a house in, let's pick San Francisco, right? Real estate prices are way through the ceiling. You come to me and say, you know what, I valued the house at $500,000. I say, what do you mean? Well, my neighbor sold his house for $1.5 million. And he said, no, it's overpriced. We can't do that. We're going to go with value. You're going to fire me on the spot. So the first thing I'm trying to bring across is if you're a banker in an IPO, your job is pricing. And we'd all be better served if we remember this. I'll give you the way it's going to play out. When Morgan Stanley screwed up on the Facebook IPO, right, they put a price of 36, and even though they tried to manage it, it was down to 28. And people started asking, how could Morgan Stanley value Facebook so badly? You know the problem with that question was? Morgan Stanley wasn't valuing Facebook, it was pricing it. The real question we should have been asking is, how could you price it so badly, especially when you have a company that was probably the most pre-priced company of all time? You know what I mean by pre-priced? It's a company that's been trading in the private share markets. You could actually observe transactions. How the heck could you mismanage the pricing so badly? And again, with the Etsy IPO, you're hearing the story. How could you, no, because if you read the stories, what did it do on the opening day? It doubled. In all again stories, how could they value Etsy so badly? That's really not the question. How could you price it so badly? Because here's the process by which investment bankers attach a price to an IPO. They make up a number. Let's face it, they make up a number based on something times revenues. And what's the next step? They get on the phone. They call portfolio managers. So will you pay $30? If they get too enthusiastic a response, guess what they do? They raise it to 35 because will you pay 35? Too enthusiastic, 42. Not enthusiastic enough, 38. This is the pricing process. We make it look more sophisticated than it has to be. Of course, after they come up with the $38, they have to reverse engineer the valuation to make it look like they went through this deep valuation exercise to come up with 38. But it's a pure pricing process. And if you decide that it's a pricing process, remember that as an investment bank you have different groups you're catering to, right? One is you have to worry about yourself. After all, you're not a charitable institution. How do you get paid? You get and it's a percentage of the proceeds usually. So basically there's a, so, and you have to, and those fees are a percent of the proceeds, but there's potentially a cost, right? And that cost arises when? And remember, the two types of mistakes you can make. You can underprice an offering or overprice an offering. If you underprice an offering, you collect less because the proceeds are less. But if you overprice an offering, then disaster strikes. Because what do you have to do? You've got to pick up those shares at the guaranteed price. And so if you're going to make a mistake, you want to underprice rather than overprice. So if you're thinking about yourself, you're going to say, this is the price, 25. But you're not going to try to come in at the price. You're going to try to come in at 23 or 21 and 18 or 15. In fact, the lower the price, the easier it is for you to get rid of this stuff, right? In fact, you have a second group you're trying to keep happy. Those preferred clients you have, you know who they are, right? I remember when Facebook went public. Roy Smith comes in my office and says, did you get your offer yet? And I said, what offer? So Goldman is offering shares. And I said, you're special, Roy. You're a preferred client. I'm not. So preferred clients are these clients who are big clients who spend a lot of money through you. And you offer them these shares at the offering price. Of course, this is a gift only if you, again, if you think about their incentives there, the lower the offering price, the happier your preferred clients are going to be. So you're saying, this is all pushing my price down. The only counter to this is there is one loser when you set the price too low, which is the issuing company, right? So on the offering day, Etsy obviously left a lot of money on the table because when the price jumps after the offering, that price jump goes to the preferred clients. It doesn't go to the company. So one thing we're going to talk about today is keeping the balance between those interests because you don't want anybody to be really pissed off at you. Obviously, you don't want to be too pissed off at yourself. Now, as the investment banker, you don't want your preferred clients to be too pissed off at you. You don't want the company to be pissed off at you. And we're going to see how that balance plays out, especially as IPOs have changed over time. So if we look at the underwriting guarantee, we kind of talked about this. You are going to start with the price, in this case the $25, and you're going to discount the price. You're going to discount it because if you're going to make a mistake, you'd rather that it be too low rather than too high. So I've never understood why in finance we call this the IPO puzzle. Right? All the papers that are written on the IPOs, why do investment bankers underprice IPOs? This is a stupid question. We can see why they do it. We can ask other questions about why the issuing company is okay with it, but it's perfectly sensible for them to underprice offerings. And if you think about underpricing the offering, the benefits that flow to the investment banker is you're guaranteed the offering. You might make less proceeds, so basically your 6% of the proceeds might be a smaller number, but you bear almost no risk. In fact, if you set it low enough, it's almost a risk-free. The underwriting guarantee kind of disappears. Your preferred clients like it. The question is, why would the issuing company go along? Why do issuing company, I'll actually tell you 90% of, right now for instance, if you ask me, is Etsy upset about, I think Etsy is actually delirious about the fact that their offering price doubled. Why are they? I mean, if they're leaving money on the table, how come they're okay with it? Anybody? Yes.
Is it because management usually, like, management, like, owns the company before the IPO and probably after the IPO also, so that even though like the company is worse off, the management team itself is not.
Well, at least at the time of public, there is no separation between management and owner. The management of Etsy is actually the founder owners of Etsy, right? So you are selling a piece of your company for less than what you could have got. So on the face of it, that's bad news. In fact, I'll tell you, if you're selling 50% of your company, if Etsy had been offering 50% of its outstanding shares on the offering day, they'd have been tremendously upset about what happened. But you know what's changed? 30 years ago, IPOs actually, a big chunk of the company was offered on the offering day, 30, 40, 50, 60%. Today you look at most IPOs, and this is my, never mind, you can get there. If you look at most IPOs, what you're offering is not 50% of the company, it's often 5, 6, 8%. Now do you see why this might affect how you react to that opening day? It is true you've left money on the table, but what do you get as a benefit? You get this public relations piece almost in the Wall Street. It's almost, have you heard of loss leaders in retailers where they have this table filled with stuff that you don't need at half price? And what they try to do is try to get you to buy that and keep sucking you deeper and deeper into the store. And then before you know it, you're in the Ralph Lauren section. And then they're hoping you'll overpay for that sweater before you leave. That's pretty much what an IPO has become, is that initial offering day has become almost like a public relations game. They're hoping that other investors will read the news story about Etsy. These are investors who are not part of the offering. And what are they going to do the next day? They're going to call their broker and say, I want to be in Etsy too. They're hoping that this process plays out. So when the shares, the rest of them, remember that many of these shares are actually locked up until 6 months or a year after. They're hoping that the glow lasts until the VCs can kind of dump their shares. It's become a game. And that's why many companies are actually in cahoots with bankers and underpricing their offerings. They're not upset because they hope to get a bonus in terms of other investors. The momentum and mood game essentially will push their prices up even more. Yes, sir.
So could you achieve the same result by underpricing it by like 20 or 30% as opposed to like half?
The question is, I mean, you could, but if you're, if you want excitement, let's face it, Etsy got a lot of public relations play out of the fact that its stock jumped. It doubled. 20%, people are going to say, well, that's what you expect in an IPO anyway. So you're going to see this little news story went public yesterday, prices jumped 20%. The Etsy news story was about investors demanding to buy the shares. The fact that Twitter's on opening day, the trading was delayed by 2 hours because of an imbalance of buy versus sell orders. That becomes part of the news story as well. So it's almost a psychological game you're playing. The IPO game is a pricing game. It's a mood and a momentum game. And anything you can do to kind of keep that going is good for you. So it's all little psychological signals. That's where I think Morgan Stanley screwed up. Because for this mood and momentum game to be played, you got to maintain the illusion that this is not a mood and momentum game, right? That's the only way you can do it, because all investors have to delude themselves into thinking that they're really doing this because the value is there. They're not doing it because everybody else is doing it. What Morgan Stanley did with Facebook was they acted like mood and momentum was all that mattered. That didn't matter what the fundamentals were. If you remember, I think the week before the IPO, GM pulled its ads from Facebook, saying they don't work. Now, if this is about fundamentals, what are you doing as an investment bank? You're running out there and explaining to people why this is okay, that this was just a small problem. Morgan Stanley didn't even respond to it. They said, who cares about fundamentals? It's all mood and momentum anyway, and that's something you don't want to do. Because once you make it that bare, then investors start looking and say, why are we doing what we're doing? And you never want introspection on the part of investors if they're playing the mood and momentum game. So there are lots of interesting psychological games with IPOs that perhaps we'll get a chance to talk about as we go through today. So let me close this up. And open up packet 2. So last session I was setting up this process where you're an investment bank, you're interested in buying a restaurant, and I And I set the process up. The restaurant's reported profits, and you're deciding how much to pay for this restaurant. So I'm going to take you through the process of valuing this restaurant as a private buyer, and you're going to see the hurdles you're going to have to cross to come up with the value. So here's the first thing. I show the financial statements for the restaurant. So right now it looks like you're making $180,000, or basically you're making $400,000 in operating income, $240,000 in net income. But here are the things that I forgot to mention. Basically, when I showed the wages, you don't see a wage for the chef, because the chef is the owner. He's never charged himself a salary, so you got to factor that in. Because remember what I said last session. I said you can't cook. So if you buy this restaurant, you don't have a chef, you're in big trouble, because you're going to be boiling eggs in the back and sending out boiled eggs to everybody who comes in. And I don't think there are going to be too many people left in the restaurant. So that's something to factor in. Second, like everybody else, they have lease expenses, but they're treating them as operating expenses. So the income statement looks like this, but you might have to do some cleaning up on the income statement to make it at least what it means. So here's the first step. Let's start by asking, how do I come up with costs of equity and costs of capital for a private business? Okay. Couple of things to remember. When we did public companies, we took the beta and it captured the market risk in the investment. We fed it in, we came up with the cost of equity. I know some people use regression betas, which makes it even more messy with a private business. But here are a couple of things that we know that doing that will cause trouble for us. One is, as a private business, I cannot assume that the risk that is firm specific is going to get diversified away, because the owner might not be diversified. And that has to be factored into my analysis somewhere. And second, I'm going to have no market prices. I can't run past regressions. So here's how I'm going to try to estimate the beta and cost of equity for this privately owned restaurant. I initially looked at other publicly traded restaurants, and the beta that I came up with is 0.86. So I went into Bloomberg, I looked up betas, and then I took a look at that list, and I realized it was not a good list for the company that I was valuing. I'm valuing a high-end, high-priced restaurant. These are all fast food chains. Applebee's might be the most highest price, and that's not saying much. These are not the kinds of restaurants that I'd want to use. And if you think about discretionary and non-discretionary, I'd expect the beta for this restaurant to be much higher than publicly traded restaurants. So here's what I did instead. I looked at 45 high-end retailers, arguing that the people who eat at my restaurant are also probably going to be shopping at Tiffany's and Gucci's, not at Walmart. The beta for those retailers is 1.18. I'm going to use that as my beta for a restaurant. So already I'm breaking the rules, right? You're supposed to stay sector focused. I'm saying in this case, the sector doesn't give me a beta that works for me. I'm going to go to high-end retailers, and that beta is what I'm going to use as the beta for this restaurant. I still have a problem. That is the beta for just the market risk in a retailer. If you're the investment banker buying this restaurant, after you buy this restaurant, all of your wealth is going to be tied up in this investment. So let's set up an algebra problem. The market beta captures only the units of risk that's market risk. Risk you cannot diversify away. And if I'm valuing a public company, I stay focused on that risk because I assume that the remaining 80 units of risk gets diversified away. You're a private owner. You're not diversified. I would argue that when you look at this company, you're not going to see just the 20 units of risk. You're also going to see the remaining 80. Intuitively, you see what I'm saying? Basically, if you're not diversified, you see all risk, not just market risk. So here's how when I first ran into this problem, I tried to work myself to a solution. I know what the market beta is for the market risk. If I now know that you as an investor are exposed to the rest of the risk, if I could somehow scale up the beta to capture the rest of the risk, that beta will better capture how much risk you see in the company. And to differentiate that from a standard beta, I'm going to call that a total beta. So market beta captures only the portion of the risk that's market risk. A total beta brings in the rest of the risk into the process. It's like doing an algebra problem. I'm just scaling up the risk for the rest of the risk. So that's basically what I did, is I took the high-end retailers and I looked up the R-squareds across the regressions. So remember, when you run a regression for a public company, you get the beta and you also get the R-squared. I looked at the R-squared. The average beta across the high-end retailers is, average R-squared across those high-end retailers is 25%. So 25% of the variance in a publicly traded high-end retailer comes from the market, 75% is firm specific. Now this is a little statistical artifact, but beta is a standard deviation measure. It's not a variance measure. You're saying, so what? If 25% of my variance is explained by market risk, I have to take the square root of that R squared, which of course is the correlation coefficient, which gives me 0.5. That 0.5 is half of my standard deviation is market risk, and the 1.18 captures that risk. I'm scaling it up to capture the other half. So all I'm doing when I divide the market beta by the correlation is I'm scaling up the beta to capture the rest of the risk in the company. So what I'm saying is when you as the investment banker look at this restaurant, what you're going to see as a beta is not 1.18, which is the market beta. You're going to see twice that number. On my website, I actually report total betas by sector. I do it primarily for private appraisers who are working with a software company or a steel company to allow them to scale up the market beta to capture the rest of the risk. And it works only if you're completely undiversified. So what's that going to do? That higher beta is going to push up my cost of equity for a private buyer of this business, and it captures the rest of the risk. Any questions on the process by which I'm getting either the numbers or what I'm doing to scale up the beta? So that's going to be my beta for this particular cost of equity. Now I run into a little problem, and it's again, you go ahead.
So you used high-end retailers
Right.
on the regression, but aren't we trying to like get the idiosyncratic risk? So like, wouldn't the idiosyncratic risk for a restaurant be closer to like other restaurants?
No, if you're a high-end retailer, the idiosyncratic stuff will be, we might be part of a fad or a, So the things that so if you're thinking about a retailer like Walmart, the idiosyncratic factors that drive firm-specific risk at a low-end retailer are going to be very different than the idiosyncratic stuff that drives a high-end retailer. So I'm arguing that what a high-end retailer shares with a high-end restaurant is not just on the beta, but also on the rest of the risk as well. I mean, it's entirely possible that that's not true in a certain company, in which case you can mix and match. But what you're trying to do is scale up the beta to capture the rest of that risk. Okay. Any other questions? So one final step here. Once I get the unlevered beta with the public company, what do I need to do? I need to lever that beta up. To lever the beta up, I need a debt to equity ratio, and here's the problem. I need a market debt to equity ratio. See why this is going to be an issue with a private business? I've got the unlevered beta of being in the business. I have a debt to equity ratio, but the only debt and equity I have are book values. And you can never, ever use book value debt to equity ratios. Here are the two choices you have. One is you can look at those publicly traded companies in the business and look at what their debt to equity ratio is. And we'll talk about what I did for that. Here's the other, and it's tricky, but it's actually very interesting. You can use your own estimated values of debt and equity from your discounted cash flow valuation as inputs into your levered. You see what you're doing is you're doing a DCF valuation, you're getting debt and equity from your valuation, you're feeding it back as a debt to equity ratio to get both levered betas and cost of capital. What's the problem with that though? Is to get to the value I need a cost of capital. To get the cost of capital I need a value. There's going to be circularity in your valuation. But that's okay if you can check the iteration box in Excel and let it work through. Both solutions are okay. I would suggest that if you're not comfortable with the iteration box, that use the first one. Just take the publicly traded companies in the space, look at the debt to equity. And here, when I did the debt to equity, I did go with restaurants debt to equity. Not the retailers. But I did mix and match it because I made the assumption that at least when it came to how much you borrowed, what a restaurant borrows is going to be different than what a retailer borrows. But again, that was a judgment call. That debt to equity ratio fed back gives me a levered beta of 2.56. That 2.56 beta, the risk-free rate, which is 4.25% then, and an equity risk premium of 4%, gives me a cost of equity for this private business. So let's go through the sequence. If I came to you with a private business, you can't go to Bloomberg and look up a regression beta. So that choice is out of the road. It's not even possible. But you can look up a bottom-up beta still for your company. You then have to make a judgment as to whether the buyer is diversified or not diversified, because that will reflect how much you scale up the beta. And it's that total beta that will drive your cost of equity, not the market beta you'd have used with a public company. So that's the cost of equity. To get to a cost of capital, I need two more pieces, right? I need a debt ratio and a cost of debt. I've actually done the debt ratio already, because when I made this decision about the debt to equity, That's also going to become my debt ratio and my cost of capital. To get the cost of debt, though, there's only one route you can follow. You can't look up an actual rating for your company, because if it's a private company, odds are that there will be no bond rating. You have to estimate a synthetic rating. That's effectively what I did. I took the operating income divided by the interest expense, which is all leases. I came up with an interest coverage ratio that I fed into that small company table to come up with a default spread based on the synthetic rating. So it's not the rating that's my end game, it's a default spread. And that default spread that added into the risk-free rate gives me 7.5%. Net of the tax benefit is 4.5%. The cost of capital that I get for your company as a private buyer is 13.25%. In a little while I'll show you what the cost of capital would have looked like to a public buyer, and it's going to be much lower. But as a private buyer, because you're not diversified, that is the cost of capital you'd have for this company. Okay? Any questions on cost of capital? So private businesses, you got to think out of the box. You got to first use only bottom-up betas and then adjust for the fact that buyers might not be diversified. Second step, I cleaned up the income statement. Yes, sir.
So is the difference between a private buyer versus a public buyer, is that manifested in the cost of equity only, or also in the cost of debt?
It's usually the cost of equity, because the interest coverage ratio is the interest coverage ratio. It's a small company still, so I can't let a buyer subsidize this based on the fact that he can borrow money at a really low rate. Right? I'd love it. As a seller, I want you to subsidize it, but if I want a fair value, the 7.5% will stay what it is, but the cost of equity will come down. Yes?
Sorry to backtrack a little bit, but
Yep.
if you're provided like historical earnings and income
Right.
statements for private businesses, is there a way to, or regression, or determine approximate weights of, let's say, 70% of the risk comes from the retail portion, high-end retail, and 30%?
You don't need a regression, you just need a breakdown of business, right? So if you had the equivalent of what public companies report, I mean, you look at a public company, they break themselves down into businesses, right? So if you have to, so if you run a, so as an example, if you ran a restaurant but you had a small store on the side where you sold prepared goods, you'd have to figure out how much revenue you get from each. So it might involve asking questions of the owner, because they might actually not do a segment breakdown. But if you ask the questions, you should probably be able to get the information. Okay. Yes?
So we can use the same equity risk for you.
Yeah, the price of risk is not changing. Basically, the price, that's a market price per unit risk. What's different is you face more units of risk in the same company because you're not diversified. If I hike up the equity risk premium and use a total beta, I'll be double counting. So I make the decision early on that the price of risk I can observe by looking at the market, but I still have to estimate how many units of risk you're exposed to based on whether you're diversified or not. Now let's talk about cleaning up the financials. All that requires is first I put in another $150,000 for a chef. Again, you're saying, how do I know that? You're entering this business, you better start calling around to find out how much it will cost you to hire a chef. You can't just make up a number and say, oh my God, it'll cost me $500,000 instead. I threw that in. I converted leases to financial expenses for the same reason I do it for any other company. My adjusted operating income is going to be different because of that. It's $370,000 instead of $400,000, and it shows up as a net income difference. It was a little easier here than in some private businesses where you might have invisible employees. But remember, if you're buying this business from the owner, he has an incentive. This is your best chance to extract information from him or her, because he has an incentive to tell you what's going on, because it'll make his income look better, to tell you these two employees don't do anything. I just used to pay them because they're my nephews. So factor that in when you do the expected value. They had no debt with their original stated financials, but when I capitalized leases, that now shows up as debt. So $928,000 is the debt you owe. Right? So here's what I'm going to do next. I have my earnings statement. I have my cost of capital. Yep.
Sorry, if we're talking about like a restaurant where the chef is so deeply tied to the restaurant that you anticipate like a loss of business because that chef.
Yeah, that's what my next question is going to be, because all of these financials reflect the existing chef whose name obviously played a role in whether people will come to the restaurant. Because you look at, especially a high-end restaurant, the chef's a big deal, right? So the question is, if I buy this restaurant, even if I hire a really good chef tomorrow, will I be able to replicate the financials? And this in private company business is what's called a key person discount. Okay? Sounds fancy, but here's the question I'm asking. If tomorrow I ran this restaurant, how many of the existing customers will stop coming? It's a big deal in medical and dental practices especially. Because if you think about it, you have a doctor, it's not just a service you're going to, it's the same. So let's say you're a dentist, you've been in the town for 41 years, you built up this great clientele. When I look at your financials, I see you making tons of money. So I decide to buy your business. I'm a young dentist, I want to buy the practice. I look at your earnings and I pay 5 times those earnings. Next day I walk in, you're gone. First patient walks in. He says, who the hell are you? So I'm the new dentist. So I'm leaving. Because he or she was expecting the old dentist. That's what you're trying to quantify with the key person discount. You say, how the heck am I going to do that? You have no choice but to make your best judgment. You might stand outside the restaurant for the 2 weeks before you make the offer, and as people come into the restaurant, say, if I had so-and-so, would you still come to the restaurant? There's not a chance. You're going to file that away. In this case, I'm going to assume that based on whatever limited research you've done, that you conclude that if the existing chef leaves, he sells you the business and leaves, you're going to lose 20% of your revenues and operating income. You know, all I need to do is take the existing operating income, which is $370,000, knock 20% off that, saying if the chef departs, I'm going to lose 20%. And the more I worry about the key person leaving, the less I'm willing to pay for the restaurant. So if you're the chef who's trying to sell the restaurant, do you see the quandary you face? The value that I'm willing to pay for this restaurant is much lower because I'm worried that when you leave, you're going to take half your business with you. If you're a dentist and you're trying to sell your practice, I'm paying you a much lower price than your earnings merit because I'm worried that you're going to be leaving tomorrow. So is there something you can do to buffer the impact?
What they actually do, at least in dentistry, is the dentist that's selling will stay on for a year or 2 years.
There's often a transition period where the existing dentist, the existing doctor, the existing chef might say, for the next 2 years, I'm going to stay on, transition hopefully so that 2 years from now people will continue to come. You say, but I want to move to Florida. Well, if you move to Florida today, you might get a price 50% lower than what you would get if you hung around for a couple of years. So in personal service practices, whether it's a plumbing business, a dental business, a doctor, or a medical practice, you'll often find this transition period where the existing doctor, dentist, or plumber stays on. Because if they don't stay on, you're going to knock off so much of the value because of the key person discount. So that's something you don't run into as much with public companies because no key person should be worth that much. But even at some public companies, it could be an issue, right? So I'm not sure what Tesla is worth without Elon Musk. Something to think about, right? So if you're buying Tesla and he's going to leave as a consequence, would you pay the same price? Maybe you'd pay more. I mean, that depends on what you think about him. Are these value adding, value destroying? But I'm saying that in public companies, we tend not to worry too much about this, but with private businesses, you definitely have to. Any questions on the key person issue? So you got the discount rate, you got the earnings, you kind of corrected the earnings for the key person leaving or staying around. You can't abandon valuation fundamentals just because you're valuing a private business. What I mean by that is, remember the link we had between growth and reinvestment and return on capital? That still applies if you're a private business. In fact, to get my reinvestment rate in this restaurant, which basically means I've got to replace the furniture, I've got to replace the stoves, the ovens, whatever, I have to put aside money. That's what the reinvestment year is going to be. And I'm going to assume that that reinvestment is a function of what I want to grow at, which I've set at 2% here, and what kind of return on capital I can earn as a private business, which might come from having a great location and that reinvestment rate I come up with is 10%. So that's what I'm going to take out of my earnings to get to cash flows, and it comes just as with a public company from the growth and the return on capital. And I'm going to do this even if I don't plan to grow the restaurant in size because I still have to maintain the restaurant's earning power. So here's the last step. Or not quite the last step, but the valuation of the restaurant. My adjusted operating income with the 20% drop for the key person leaving is $296,000. My tax rate is 40%. My cost of capital, incorporating the fact that I'm not diversified, is 13.25%. My reinvestment rate is 10%. So I take my $296,000, which is my operating income. I grow it 2% to get operating income next year. I net out the taxes, the 40%. And I net out the reinvestment. So it's a kind of shortcut to get to free cash flow to the firm. Divided by cost of capital minus growth, the value that I get for the restaurant is $1.449 million. I'm not quite done because that's the value of the entire restaurant. But remember, I capitalized leases to treat them as debt. I need to subtract them out, and the value that I get for the equity interest that the chef has, which is all he's selling because you're getting the lease with the restaurant, is $521,000. Okay. I'm sure he's going to be disappointed because the $521,000, if you think about it, is a multiple of income or is like 3 times income. And with private businesses, that's often the kind of multiple you'll see. One other thing, do I have to use a perpetuity to value business? What if I told you that this lease, you get only one more renewal of and then you're pretty much done? So you have 20 years and that's it. What did you do differently? Treat it as a growing annuity, not quite an annuity because you still have the 2% growth. You'll have a growing annuity for 20 years. Take the present value. With private businesses, I'm far more inclined to not use the perpetuity assumption because most small private businesses we know will not last forever. And often we'll use the lease term of a store or a retailer to decide the value because once the lease runs out, it's anybody's game as to whether they can actually renew it and keep going. So a little trickier than a public company, but I think it's a lot more fun because you get to ask questions of the owner and try to bring the answers into the valuation, but that's your job in private company valuation. $521,000 is the value of equity, right? So are you ready to offer me $521,000 for the equity? So let's say you do. It's the rest of your savings. You buy the restaurant. Tomorrow it's your restaurant. You come in tomorrow and you realize first that you have to come in like 7 o'clock in the morning. And you got to stay till midnight, 1 o'clock. And then you go home, you got to repeat this the day after and the day after. And after about 3 days of doing this, so what was I thinking? I'm going to go back to investment banking. So you have to now sell the restaurant, right? We talk about illiquidity as a strange, difficult number. You know what illiquidity is? It's the cost of buyer's remorse. Have you ever had buyer's remorse on an investment? It usually happens around 3:40 in the evening. That's a very dangerous time, that last 30 minutes of every trading day. And if you have Jim Cramer on the TV, the danger increases exponentially because the guy drops stocks like, 15 a second. So let's say it's 3:41. You're just weak. It's been a long day. In a moment of weakness, you listen to Jim Cramer. Big mistake. Then you do something based on it. Huge mistake. You put this buy, and then you say, what the heck am I doing? Some crazy guy screaming something on the TV. I bought based on that. And if it's a public company, what's the cost of buyer's remorse? You hit the sell right away. Is there a cost? It's $8.95 each way if it's E-Trade. But there is, even if the price hasn't changed, what's the other cost? There's a transactions cost, but that transactions cost takes the form of a spread, the bid price and the ask price. So even if nothing is, you think, how big can that be? With IBM, it's nothing. But if you bought that small NASDAQ company, you might have bought it too and sold at 180. That's a 10%. So there is an illiquidity discount with public companies. We just call it a bid-ask spread. You see why it's going to be even bigger if this restaurant doesn't work for you? You try to sell it 3 days from now. Good luck to you. You can't go online and say, buy a restaurant. You can try Craigslist. Right? Want to buy equity in a top-notch restaurant, send $521,000 through PayPal. We'll send you the restaurant the other direction. Right? It's not easy, right? So here's what happens. Even if you like the private business you're buying, you have to factor in some kind of discount because you might change your mind. You've got to do it up front. You can't wait till you've changed your mind because by then it's too late. So the question you're asking is, how much should I knock off the $521,000 in case I'm wrong? So I'll start with my proposition about illiquidity, and you tell me whether you disagree with it. That's a cost, but how much that cost is will vary across companies. We talked about healthy companies versus unhealthy companies, mature companies versus growth companies. It might be easier to sell some private businesses than others, so the discount should vary across companies. It should vary across time. We talked about the last quarter of 2008 versus right now. It's going to be far easier to sell a business, even if it's a private business now, than in the last quarter of 2008. And it should vary across buyers. Remember, I said this is what you're taking off because you're worried you might change your mind or you might need the cash. But what you might need and what I might need in terms of liquidity can be very different. So I don't disagree with the notion of an illiquidity discount, but I would think it would be different for different businesses across different time periods and for different buyers. So hold on to that thought, because I'm going to show you how most private appraisers deal with illiquidity. They knock off a fixed percentage, 25, 30%. If you ever worked in private company appraisal, it's a big number and it's a constant. And if you ask them to back it up, they'll point to two sets of studies that have been done over time. One are studies of what are called restricted stock. And I'll in a few minutes explain what that is. But these are stocks which are issued by publicly traded companies that bypass the SEC filing requirements. So you can actually issue these shares. You think, this is great. Why doesn't every company do it? Well, here's the catch. If you decide to issue restricted stock, you don't have to do the SEC filings, but the people buying those shares are not allowed to trade them for a year after they get them. Do you see why this gives you a chance to observe illiquidity in practice? These are public companies, so you see the price, right? You have a restricted stock offering in the company. You're getting the shares, but you can't trade it for a year. You're not going to pay today's price because I've restricted how much you can trade it. You're going to buy the shares at a discount. We get to observe that discount. So the first set of studies look at restricted stock discounts, and I'll show you what those studies seem to find. The second is studies of transactions that happen just before IPOs. You're saying, what kind of transactions? These are co-owners of companies selling shares to each other. So you get to observe 2 months or 3 months before an IPO what the price on this transaction is. And what these studies do is they compare that price to the actual IPO price. So let's say that you and I are co-owners of a company. 2 months before the IPO, I buy your shares at $8 per share, and the IPO is at $10 per share. The discount you're going to observe then is a 20% discount. That's what these IPO studies do. So these two sets of studies are what back up these 25, 30, 35% discounts that people use. So let me start with the restricted stock studies. For the first 20 years or so, these were the only studies before, so they predate the IPO studies. Almost every study, here's what they would do. There are only about 30 or 35 companies each year that use restricted stock issues. It's a very small sample. They would get the sample across 5 or 10 years of 200 companies or so. They'd compute the discount at which these shares were placed with investors relative to the market price, and then they'd average the number out. If they were being sophisticated, they'd report a median. And then they'd say that's the end of the study. So for about 20 years in private company appraisal, what you had was a constant. These studies would say, on average, in restricted stock issues, there's a 35% discount, and then every appraiser would take the 35%, feed it into their valuation, and pass it through. And courts were fine with it because that's what the data suggested. It's interesting that of all the papers that Bill Silber's done, his most quoted paper is actually almost a throwaway paper he did one summer. He laughs about this, where he took the restricted stock samples that everybody else was looking at, and rather than just focus on the median or the average, here's what he did. He said, I have 200 restricted stock companies. They've all issued stock. I can see the discount on each of them. Rather than just report the average, wouldn't it be neat if I could see why the discount is smaller at some companies and larger at others? So he ran a regression where he took the restricted stock price as a percentage of the actual price. So it's 1 minus the discount on the left-hand side. And he ran the regression against a level of revenues, arguing that bigger companies should see smaller discounts in smaller companies. Whether the company, or second, how much the restricted block was, arguing that bigger blocks should have bigger discounts. So if I'm trying to sell half the company in a restricted stock issue, the discount should be larger. And he ran a dummy variable on earnings, where he said if the earnings are positive, the company is making money, I should expect to see a smaller discount. Now how many variables he tried, but this was his final regression, is with those 4 variables, he ran a regression against, and he ended up with an equation across his 200 restricted stock companies. So what he's done is taken what those old studies reported just as a median and reported this is what causes the restricted stock discounts to vary across companies. What I did was I took a study and I took pieces of a study. What do I mean by that? If you look at the coefficient on revenue, that's telling me how much as my revenues go from 5 million to 10 million to 20 to 50 to 100 million, my discount is getting smaller, right? So I have I have an effect. Just like I use my PE ratio regressions or price to book regressions, I have a measure of how much higher revenues translate into lower discounts. I also have a measure of how much, if you're a money-making company versus a money-losing company, how much smaller your discount is if you're a money-making versus a money-losing company. So what I did was I took that base discount. So the first time I did this, private company appraisers used 25% as their base. I said, okay, give me the 25%. I'll make that my starting point. And then I will adjust that 25% for whether you're a money-making or a money-losing company and what your revenues are. So the way to read this graph is, if you're a company, let's say you're a private business with 100 million in revenues, which is a pretty big private business, and you're a money-making company, based on the silver regression, your discount should be only 22%. I'm adjusting the discount down because you have a lot of revenues and you're making money. In contrast, if you're a $5 million revenue company that's losing money, based on the regression, your discount should be closer to 35%. It's a quick and dirty way of adjusting that fixed number for whether you're small or large, whether you're money making or money losing. But it's still built on those restricted stock studies. So basically, if you run into private company appraisals and you see them using 35% as a constant, at least suggest this one way in which they can differentiate across companies based on the size of the revenues and whether they're money making and money losing. The second set of studies started showing up about 20 years ago. I'll have to tell you something though. When you think about the people using these studies, they're private company appraisers, right? And we talked a little bit about the bias in private company valuation, which is to push numbers down or push numbers up. What do private company appraisers do? They often are estimating your value for tax court or for divorce court, which effectively means you're going to see this pressure to push the value down. So they love big discounts. So start off with that recognition. They love big discounts and they're going to go looking for studies that back the use of big discounts. So this is now private company appraisers' favorite study, pre-IPO studies. And I don't for a second believe these studies. And here's what. The discounts they show are huge, 40%, 45%. Here's why I don't believe it. Let's assume, again, we talked about you and I being co-owners of a private company. We're planning to go public. Let's make it Snapchat. We're co-owners. We're planning to go public in a month and a half or 2 months. We have a pretty good sense of what we're going to go public at, right? Let's say it's going to be $20 per share. But I'm in a hurry. I want to get out of this now. It's true there is some risk associated with that month and a half. But if you believe these studies, you know what I'm telling you? That I'm going to sell my share of the company to you at $12 per share. Even though I know the expected value is 20, and walk away. But he's saying, but that's what the research indicates. You know what's missing here? These are the companies that actually go public. Does every company that planned to go public actually end up going public? No, there are a lot of companies that don't make it. Both restricted stock studies and IPO studies have a fatal flaw. They have a sampling problem. Restricted stock companies tend to be basket case companies. None of them are healthy. Strange things are going on. The kinds of companies we have a lot of transactions pre-IPO are not the best of the public companies that are going, or private companies going public. The companies that often have strange things going on. You're selling at a big discount because you're uncertain about whether there's going to be an IPO and what the price is. It's not an illiquidity discount anymore. It's not for a month and a half of cash that you're charging the 40%. It's the uncertainty involved in the IPOs. It's my biggest problem with all of these studies is because of the sampling bias. I think we're overstating the illiquidity discount, which serves appraisers great because they want a big discount. Until about a decade ago, courts accepted this discount without question. So you go into court and say, I value the business at $100 million. I knocked off 35%. That's $35 million. You just took off my value. And you back it up with an IPO study and say, look, the restricted stock said, look, these studies show that's okay. And the court said, that's fine. About a decade ago, the IRS finally got tired of collecting less in taxes. And they stopped being cheap, which basically meant that they were willing to spend money on an expert witness who actually knew what he was talking about. So they called in this expert witness who was more statistics than finance. And he came in and he looked at these studies and he said, there's a sampling problem here. These restricted stock companies are not a random sample of 200 companies. They're bad companies, companies on the verge of disaster. And what he did was actually very clever. He took that 35% restricted stock discount and he broke out how much of it came from the sampling problem. which is troubled companies, strange companies, and how much came from illiquidity. And his conclusion was less than 10% came from liquidity. The rest was a sampling bias problem. So now you have two numbers in court. The expert witness for the appraiser, the private company appraiser, was saying 30% because that's what the restricted stock studies gave. The IRS had come up with an expert witness who said it's closer to 10% if you strip the sampling bias. And courts being courts, guess what they ended up using? They split the difference and went to a 20%. This is why valuation in the legal system is bound to fail, because you basically have two expert witnesses, you split the difference, you get neither fish nor fowl, but that's the process that we still follow to decide what the value of private companies. We do this valuation and then we start to strip out that. In fact, over the weekend I actually posted on this very widely used practice in valuation, which is adding a small cap premium to your cost of equity. If you get a chance, read it, because it's very directly relevant to this class. Because if you go work in valuation, this is going to be standard practice, not just at private appraisers, but at many investment banks use it, many equity research analysts, which is they add a small cap premium of about 4% to your cost of equity if you're a small cap company. Saying what's small cap? Well, some of them just make up a small cap. Others say if your market cap is in the bottom decile of public companies, it's small cap. But you see the consequence it's going to have, right? You push up your cost of equity by 4%. Your value for a small cap company will therefore be lower than what it would have been without the small. So there's huge consequences. So in the post I look at the basis for it. And the biggest basis was there's a historical small cap premium. Is there? You look at the last 88 years, there is. Over the last 88 years, small cap companies, companies in the bottom decile, have earned about 4.33% more than the market is saying. There, we have a basis. That's 1926 through 2015. You know what it is 81 through 2014? 0%. In the last 35 years, there's been no small cap premium. So we're building in a premium that exists only because you keep stretching history till it shows up. And here's the second problem. Many private company appraisers put in a small cap premium and push up the discount rate. And if you push them, they say, well, it's because small cap companies are less liquid. Okay. So they'll push up the discount rate. They'll value the private company, and after they're done with the valuation, guess what they then do? Knock off another 30% for liquidity. Make up your mind. You want to knock off 30% for liquidity at the end, okay, I'm okay with it, but you can't add something to your discount rate because companies are illiquid and then knock off 30%. Because there's no defense for it. You can't back up with history. There's nothing you can do to back that up because you've double counted. So be very careful about illiquidity discounts because they do reflect biases that people want to bring into the process to push numbers down. So as I said, I've had issues with both restricted stock studies and IPO studies. And then when I first made this an issue, I was told, well, what choice do we have? This is the only chance we get to observe how much the illiquidity discount is. And that's when I pulled up my public stock analogy. I said, look, we're acting on the presumption that private businesses are illiquid and public companies are liquid, but that's not true. The public market is a big market. There are 8,100 companies, and some public companies are a lot more liquid than other public companies. You can't just say liquid, not liquid. It's a continuum. It's true that the illiquidity discount in IBM is tiny. It's 1/10 of 1% because that's what the spread is. But the liquidity discount on some small private businesses can be as high as, some small public companies can be as high as 20%. That's how much the spread can be as a percent of the price. So here's what I did about 10 years ago, and I'll tell you why I've never updated this study. I took every public company in the market. I looked up the bid-ask spread as a percentage of the stock price. So think of that as the liquidity discount for a public company. I ran a regression of that spread against the revenues of the public company, whether the company is, so it's very much like what you see for restricted stock studies, but now I'm looking across a much bigger sample without sampling bias. I end up with essentially a regression equation that explains differences in spreads across public companies. You see, but we want a liquidity discount for a private company. Here's what I did next. I took my private company, in this case a restaurant, I plugged the numbers into the bid-ask spread regression you saw on the previous page. So the revenues are easy. It's a private business. I can still get revenues. Whether it's making money is easy. We can look up the income statement. How much cash they have is easy. You see, what about trading volume? I set it to 0. I acted like a private business is a public company that never trades. I got a predicted bid-ask spread for the restaurant of 12.88%. You say, what does that mean? To the extent that public company bid-ask spreads vary across companies, if I treat this private business as an extension of the public marketplace, the discount should be about 13%. And if you do this for private business, you consistently get numbers between 12 and 20%. So I'm willing to accept a 20% discount on the value if in fact it's a small company losing money. But I'm not willing to accept a 20% discount on a Cargill or a Coke Industries. That would be ridiculous. These are multi-billion-dollar companies where you have the option to sell the companies. To knock 25% of their value or 30% of the value strikes me as imprudent, because it really doesn't reflect the true cost of illiquidity at those companies. So that's the illiquidity issue, and you can see that with private companies, everything is starting to weigh you down, right? The total beta pushed up your cost of capital, that pushed down the value. You have an illiquidity discount, which is separate from the diversification issue, which is pushing down the value even further. By the time I'm done, the value that I have for your equity here is $454,000. As the chef in this restaurant, you're disappointed. You're hoping for a much bigger number. So you come to say, what can I do to get a higher value? You know the easiest thing you can do? Find a different buyer. And I'm not kidding, because what's causing your value to go down? You're trying to sell to some guy who's going to put his entire wealth into this restaurant, so he worries about firm-specific risk, and he worries about liquidity, and he's taking it all out on you. If you can find a public buyer, which in this case might be a publicly traded restaurant chain, or a private equity fund, or somebody who's diversified, think of how the game changes. First, instead of looking at the total risk now, I can go back to looking at just the market risk, right? So my cost of equity, instead of being computed based on a beta of 2.36, I'll go back to the 1.18, which lowers my cost of equity. I'll leave the cost of debt. Joseph raised this issue before at 7.5%. But I work it through. Look at how much lower my cost of equity and cost of capital are if it's a public buyer looking at this business. That's going to have a huge impact on my value. That's going to push up my value. Let me ask you about illiquidity. If you're now going to become part of Arc Restaurants, which is a publicly traded restaurant company, who cares about illiquidity? Liquidity doesn't matter because investors can buy shares in the company. So not only will my cost of capital decrease, but I don't have any liquidity discount. Look at what happens to your value of equity. It used to be $454,000 when I was the potential buyer, the investment banker. If it's a public company, that value of equity increases to almost $1.5 million. So you can already see the push. If you're selling a private business, try to find a public buyer. It's not always a choice, but if there is a choice, that's where you're going to push towards because you get a much higher value. Yes, Jordan.
If you were selling to like a private, like something like Union Square or something like that,
It'll be somewhere in the middle. They're probably not going to settle for a market beta because they're not fully diversified. In fact, there's a negotiation at this stage, right? So let's say you're the owner of this restaurant and I'm a public buyer. Let's try the negotiation out. What did we say the value was to another private buyer? It's $454,000. To me, it's $1.483 million. So we're sitting across the table from each other. What are you going to start with as your starting demand? You're selling the restaurant, so you're going to say it's worth $1.483 million. You know what I'm going to counter with? $454,000. Take it or leave it. $455. I'll give you $1,000 more. And who's going to win? It depends on whether I have more than one potential buyer. If I can get two publicly traded restaurants playing off against each other, I'm going to end up close to $1.484 million. But if I am the only game in town, I being the buyer, the public buyer, guess what we're going to end up closer to? We're going to end up closer to 454. I might give you 500,000. And you might be very grateful that I gave you more than to a potential buyer. But think of how much value I've collected now as a buyer of a private business. In a few sessions, we're going to talk about acquisitions and their sorry history in terms of value destruction. The one area where acquisitions have created value is companies that buy private businesses have had much better luck in terms of delivering value, and this might be the reason. is because you don't have a market price plus, you're negotiating value. And this is how Browning Ferris was created. It's the way Blockbuster was created, by buying video stores across different towns. So if you start a business by rolling up private businesses and there is no competition, you could very well build up a very valuable business because you're eliminating the diversification discount.
Why do so many private equity roll-ups turn out like crap?
Because they pay too much. In a sense, they start competing with each other. You end up paying close to 1.483 million. And if on top of that you assume all kinds of cost savings into your earnings and cash flows, then you're raising the ante on what you need to do to break even. Like any other game, at the right price it makes sense. At the wrong price, even the best designed roll-ups are going to fall apart. Yeah. And I think we're in a game where private equity players are competing with each other for these, and they're all going after the same sectors. They're trying to roll up the same stuff. Sooner or later, they're going to push the prices up and drive out the premiums. Right. Any questions? So if any of you have friends, family with private businesses, they're thinking about selling it, keep this in mind. You want to find public buyers, public companies, diversified investors, because then you get a lower cost of capital and a higher value, and the illiquidity discount ceases to matter. Okay. Now let's talk about private company for an initial public offering. Much of what we've talked about with traditional valuation applies here because you're valuing the company for a public marketplace. So there's no talk about total betas. I don't want to see an IPO valuation we use to total beta because it makes no sense, because the buyers of this company are now going to be investors in the marketplace. But there are a couple of issues specific to private companies that you have to deal with. One is that you get a prospectus, everything's supposed to be, but here are the issues that you might have to factor in. One is that when the company comes in and you value the company, in this case I took Twitter in October of 2013, the valuation I did looks very much like a traditional valuation. Cash flows, discount back at the cost of capital, nothing different, but here are the things that I have to think about. One is, in an initial public offering, on the offering day, when I issue 10 million shares or 100 million shares at $10 per share, I'm going to get cash, right, coming into the company. $1 billion. What happens to that cash? Read the prospectus. Because in the prospectus, the company has to tell you what it's going to do with the cash. And what are the things that the company can do with cash? What are the three things? One is it can keep the cash in the company to cover future investment needs, right? In which case it just increases the cash balance. What's the second? It can pay it to the existing owners who want to cash out. So some of the owners might say, I've paid my dues, I've been in this company 5 years, it's time for me to cash out. So it could leave the company. Or it could be used to pay down debt if you've taken on any bridge loans or something. So it can be used to, can be kept in the company as a cash balance. It can be paid out to existing equity owners, or it can be used to pay down debt. What you do with the cash will reflect which of those three things happen. I'll take you through all three. The other issue, of course, is the fact that in an IPO you have this pricing component. There's an investment banker, there's an underwriting guarantee, they've got to set a price, and they've got to weigh all these different components.
Would it change if the company decided to reinvest it, or would that?
Well, you already counted into your DCF value. If I do a valuation, see this cash flow right here? It already reflects my reinvestment needs. So even if they decide to reinvest right away, it's okay because it still is like an added cash bonus that I haven't counted. And that's one of the nice things about doing a full-fledged DCF is whatever reinvestment needs you have are already built into your cash flows. This cash, as long as it stays in the company, will actually push up the value of the company.
So if they were going to reinvest immediately, you'd just be treating it as an addition to the
Basically what that will mean is that 141 million, you said at the end of year one you got to raise 141 million, you just raised at the start of year one.
Okay.
Right? Because implicitly you're already telling me you got to raise all these cash flows in the future which lowered your value. You've now raised some of that cash up front, so it basically means you got to raise less cash in the future.
Okay.
So those are the issues. The other issue is by the time a company like Etsy goes public, remember it's been around as a private business and it's gone through probably 3, 4, 5 rounds of venture capital. Have you ever been involved in one of these venture capital rounds? At each round people extract their pound of flesh. And then they build in options to protect themselves. They have ratchets and if this happens, that happens. So by the time you actually go public, you have this accumulated effect of 5 venture capital rounds, each of whom has added things, usually options along the way to protect themselves. And when you buy shares in the company, you got to figure out, or you have to be told what will happen to all of those options. Some of them will continue as live options, which lowers your value of equity. Some of them will be converted into shares at the time of the public offering, and you got to bring them into the process. So I'm going to take Twitter again to illustrate this. So when you look at the proceeds, three choices. You can take it out of the firm if you're the existing owners. You can use it to pay down debt, or you can hold as cash or reinvest right away. If it's taken out of the firm, it's gone. So basically you don't have to, so that $1 billion that comes in leaves out of the other door, and your value is going to be whatever you came up with as your DCF value. If it's used to pay down debt, you know how it's going to show up? Your debt will go down, your debt ratio will change, your cost of capital will change, and you got to figure out what the net effect of that is on your value. Maybe you're over levered, and by paying off the debt you've gone back to a more sensible levered position. If it's held as cash to cover either current or future reinvestment needs, you've got to add the cash proceeds from the IPO to whatever your DCF valuation is. Yeah.
If you're using it to pay down debt, why wouldn't you just net it out as a cash inflow, cash outflow, plus whatever?
Because it does have an effect on your cost of capital, all right? Because when the cost of capital you use to discount the cash flows reflects the debt ratio you're going to have. So there's a cash effect that comes in. Cash comes in, cash goes out, but it leaves an imprint on your future cost of capital if you've now gone from being 50% debt to 20% debt because of it.
Yeah, I'm just
Right.
thinking the difference between how your model is working mine.
Okay.
That's all it is.
You just don't double count, because if you do that and you lower your cost of capital, then you'll end up double counting. So whatever you're doing, you got to factor that effect into your discounted cash flow valuation. Okay. So let's look at Twitter. Right? One of the first things I do when a prospectus is filed is I look at the financials, 10K, the income statement, the balance sheet, the statement of cash flows. And somewhere in the prospectus, the company will also tell you how the proceeds are going to be used. So look for it. If you get a chance, pick up any IPO, pick up the Etsy IPO. It's prospectus. It's still on the SEC website. Somewhere in there they'll say, this is what we plan to do with the proceeds. Because I need to know that in order to deal with the cash. In the case of Twitter, first I had to figure out how many shares they were going to offer. Because at the time of the initial prospectus, if you look at the prospectus, it'll say Twitter plans to issue blank number of shares at a blank price. Neither has been said. This is kind of a strange place to be. So I had to actually look around at news stories to see what they plan to raise. And at least the initial news stories were that they plan to raise about $1 billion from the offering. So that's what I used in my initial valuation. As you get closer and closer to the offering date, there will be more prospectus updates that get filed. And somewhere along the way, you can start to make this more specific. But start with whatever those rumors are, $1 billion. According to the Twitter prospectus filing, the company specifies up front that it plans to use the cash or hold on to the cash to cover its operating needs. So I was checking to see, are they taking it out of the company? They use it to pay down debt? No, they were going to keep it in the company. So if Twitter had said, look, we plan to take the cash out, my life would have been a lot simpler. But because they were keeping it in the firm, I had to add that $1 billion onto my DCF value. You see why I'm adding it on? It's like a cash balance increase, which effectively means there's almost a circularity here, right? Because the price at which you plan to take the company public will determine what your proceeds are, and the proceeds will then increase your value, which can affect your price. But that's a reality, nothing you can do about it. Second, I checked to see whether there were any prior equity investors who were going to come after me as a new investor in Twitter. And Twitter had lots of prior equity investors, and it's not unusual in this. In fact, at the time they went public, there were 7 classes of convertible preferred shares. You're saying 7 classes. That tells me there were at least 7 venture capital infusions in the company, probably more. Okay? They had 86 million restricted stock units. You know what restricted stock units are? They're the alternatives to options. You reward employees with shares. These shares cannot be traded for 3 or 5 years. They had 444.16 million units of employee options with a strike price of $1.82, with about 7 years left on them. And they also had done an acquisition where they were planning to issue 14.791 million shares to cover. All of that was listed in the prospectus. What made my life simpler was they also said the minute they went public, all their convertible preferred shares would convert into ordinary shares. So basically the number of common shares I have incorporates their existing common shares plus the restricted stock units plus the 14.791 million shares, because I know all of those are going to be out there once the company goes public. So I increased the number of common shares from the stated number to include all this other stuff. The options are left as options for the same reason we leave options untouched, because I have no idea when they'll be exercised. I value them as options, and I came up with a value of 805 million. I'll also tell you the strike price is so low relative to the stock price that you might as well have just counted these as shares. You wouldn't have made that much of a difference because the optionality starts to disappear when you're this much in the money. So that factored into what you see in that final valuation is the issuance proceeds and the options are factored in. Not that different from a public company, but a little more work. Final step in the process, you got this investment banking guarantee. In almost all IPOs, the investment banker guarantees the offering price, which means if he cannot deliver that price, he's got to come up with that price and buy the shares. Right? In fact, it's estimated that Morgan Stanley ended up buying 10% of the shares on the offering day for Facebook. And if you think about how little capital investment banks have and how big some of these companies are, you can see why one bad IPO can tip you over. So here's the big question, and we've kind of addressed this. If you're the investment banker taking Twitter public, you could do an intrinsic valuation, and my assumptions might be different from mine, and come up with a value per share. My estimate of value was about $17. Yours might be around $20 or $21. Or you can price Twitter as a company. So what does that mean? When you price it, you look at what other people are pricing social media companies, and you base your pricing on what they're doing. And at the time that I looked at Twitter, it looked like the market was pricing per user, was paying about $100 to $130 per user. I know it's incredibly simplistic, but I'm going to take the $100 per user, multiply by the number of users. That's it. I've got a $21.5 billion value. See, that's simplistic. If your job is pricing, keep it simple. Find whatever metric people are focusing on, come up with the price. You can reverse engineer that number to make it look like you did all this neat stuff. But pricing should be simple, and that's basically what I'm doing. Is my job as a banker is to attach a price. I'm going to take the number of users and multiply by roughly $100 per user. It'll work a lot better than putting in a discounted cash flow valuation, because my job is not valuation, it's pricing. Now, we have this IPO puzzle in the books, and this is actually one thing that has puzzled a lot of papers written on this. If you look across IPOs, on average, we know IPOs are underpriced by about 15 to 20%. And you kind of see this when you see a day, like Etsy, you see that dumping of the price. That's something that gets repeated over the course of a year. And this has been called a puzzle, not just because investment bankers do it. We can see why they do it, but it seems like easy money. See why it sounds like easy money? I mean, let's say I create a mutual fund. Here's what I'm going to do. I'm going to take every IPO that's going to happen over the next year, and I usually know about them 2 or 3 months. I'm going to apply for 100,000 shares of every IPO. Everyone. And if I'm lucky, I should end up with this 20% on average, right? Because I'm not putting it in any one IPO. On average, the IPOs are underpriced by 15 or 20%. I should be able to make a lot of money, right? What's the catch? If it were this easy, people should be doing this, and some people try, but it doesn't seem to work for them. What's the catch? What am I planning on doing? Applying for 100,000 shares on every IPO, right? Will I get 100,000 shares when I ask for 100,000? I might get 80. I might get 100,000 in some companies, but it'll be the wrong companies, right? Do you see why? I'm going to get 100,000 shares in every company that's overpriced. I'm going to get 20,000 shares in the really underpriced companies. So when I look at my final portfolio, instead of looking like those studies, I'm going to end up being overinvested in my overpriced IPOs and underinvested. It's not hopeless. If you can figure out a way in which you can separate underpriced from overpriced IPOs, you might be able to make money. But you can't have a bludgeon where you invest in every IPO and hope to get away with it. Here's the other thing. IPOs go through hot phases and cold phases. In other words, there are some years where you'll see 500 IPOs, and some years where you see 2. In fact, go back in time. There's this graph that I have on one of my blog posts on IPOs, where I graphed the number of IPOs by year going back to the 1970s. So years like 1981, where there was 1 IPO for the whole year. If your entire investment strategy is built around IPOs, you're going to be in deep trouble in those years because there'll be nothing to invest in. What I'm saying is, if you decide to invest in IPOs, just think through the strategy. It's got to reflect the fact that some IPOs will be overpriced, and it's got to reflect the fact that there will be these periods we will not be able to there are no free lunches here. That's why when you see the next hot IPO and somebody offers to sell you 1,000, put you on that preferred customer list, you always have mixed feelings about this. There's nothing that happens for free. And there is always a cost attached to being one of those preferred clients. And finally, the reason I think the issuing companies are okay with this underpricing is very simple. If you offered 100% of the company on the offering date, and you underprice by 50% or 20%, the issuing companies are going to be really pissed off. Because you're leaving a big chunk of money on the table. But if you're offering 5% or 10%, which is what most IPOs offer today, you're okay with this because you think of the long game here and you're hoping, it's still a game, you're hoping that the pricing game works out in your favor. So bottom line, when you look at private companies, that's what I want you to think about, is think through the consequences, if you're thinking about going public, about what the process is going to look like. Maybe one of these days we'll come up with a better way of taking companies public than this investment banking underwritten way, because clearly it's not accomplishing much in terms of preparing the company or preparing investors. Maybe there's a better way, and maybe the Google template will spread to other companies. One final scenario. You have a private company. It's a very promising business. Social media company. You just started it. For the next couple of years, you plan to build the business. You're okay. You don't need any capital. You're going to use your savings and those. Based on your expectations, and all based on expectations, in a couple of years, you will have to approach venture capitalists for angel financing. And let's assume that these venture capitalists are not quite diversified investors. They're sector diversified. They have a lot of companies. And their correlation with the market index, based on what they have in their portfolio, is 0.5. So you're completely undiversified. They're partially diversified. And in 5 years, if everything goes according to plan, you plan to go public. So you're sitting there saying, what value should I attach to the company? So here's what I did. I projected out the expected cash flows like I would in any valuation. Let's assume that your market beta is 1, that you're an average risk company in terms of market risk. But for the first 2 years, remember that it's you investing in the business. You're completely undiversified. Your correlation to the market index is very low because you have all your money in one business. That pushes up your total beta to 4 and gives you a very high cost of equity. So for the next 2 years, you have a high cost of equity, not because you're a risky company, but because you're an undiversified owner of a risky business. 2 years from now, what happens? The angel financing comes in. They're partially diversified, so rather than move to 1, I use 2, because remember their correlation is 0.5. So the beta drops from 4 to 2. Again, not because you become a safer company, but because the investors now are more diversified. And you get to year 5 and you go public, your beta goes to 1. So what that means is your cost of equity is 24% for the first 2 years. When you're the only person supplying capital, it drops to 14% for the next 3 years. And then in year 5 or after the 5th year, it drops to 9%, which is now your market cost of equity. Remember what we said about if your cost of equity capital change over time, you've got to do that cumulated cost of equity. So that's what I'm doing here. The value that I get as a present value for the firm is 1.502 billion, million, whatever you want to start off with as units. Just to show you how screwed up it can get if you do things wrong. If you leave the 24% cost of equity as your cost of equity forever, because that's what you started with, you're going to undervalue the firm significantly. If you use a market beta cost of equity as your cost of equity all the way through, because eventually you're going to go public, you're going to overvalue the company. If you have a business that's transitioning from private to venture capital funding to public company on your spreadsheet, you almost have to build in that change in the cost of equity and capital that's going to come from the change financing. So that's the key factor to remember with these, with companies that make the transitions. So let's summarize. The value of a private business for a sale to a public company will always be greater than the value of that same private business for sale to another private individual. So if you look at businesses in sectors that are hot, where other people are buying in, expect to see they're worth a lot more than private business in sectors where you don't have that people interested in it. As IPOs boom, private companies benefit. So when you see Snapchat's value 15 billion, you know why it's 15 billion? Because people are willing to pay 25 or 30 billion for Twitter. In other words, the public market's health is critical if you're thinking about private company valuations. Because if the public market collapses, the private market will collapse as well. Okay? And private companies in markets where there is easier access to capital, like the US, will be worth more than private companies in markets where you don't have easy access to capital. It's one reason. If you're a technology, if you're a young entrepreneur, a European entrepreneur, you often come to Silicon Valley to start your business rather than try to start it in Frankfurt. Because even though you might have exactly the same business, your exit strategies here are so much easier. It feeds into the value that people are willing to pay for your company. And finally, if you look at the value of a private business where you can expect a transition to it becoming a public company, that private business will be worth a lot more than private companies where there's no transition. That's why it's not fair. But if you start a social media business, almost automatically you'll have a higher value than if you start a restaurant. Because for a social media company, even if it's just nascent, people are already building out roadways to you're going to go public, you're going to be worth 5 billion, it starts to percolate into your value. Restaurant, you're going to stay a restaurant, they're less willing to make that judgment. It's not fair, but that's how the world works when it comes to valuation. So final proposition, if you're valuing a private business, remember motive matters. Who you're valuing the private business for will determine how you compute cost of capital, whether you have a liquidity discount. So if you're selling your business, you want to sell it to a long-term investor who's diversified, who thinks you're a complete fool. You see why that matters? Because then he applies no key person discount. You're going, who cares? So there might be the strategy that in Asia, people are very big about making themselves seem smaller than they are. I'm nothing, I'm nothing. It might be a very good negotiating strategy. If you're selling a business, I'm nothing, I'm worth nothing, I've really done nothing for the business. Because that's exactly what you want the buyer to think, because then he's not going to be discounting your business for you leaving. So keep that in mind as you look at private businesses, and also think about the bias in this process as to why people do the valuation, because it can affect how they come up with the numbers. Next session we're going to start on packet 3. So if you haven't printed it off yet, or if you bought the packet from the bookstore, it has packets 2 and 3 already incorporated in it, but if you're printing it off, please print off packet 3. That's it. The third quiz covers only through the end of packet 2. So we're done for everything for the third quiz. So what we do on Wednesday will not be on the third quiz.